Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Market cycles. Well, this is something that a lot of people talk about, but it's usually evident in retrospect. What am I talking about? Well, usually they say that equity markets work in cycles of 3 to 5 years. There's a boom, and there is either a time correction or there is a bust. The question is, with regard to small cap funds, are we through the worst of it? And this is, of course, the start of 2026. It's been painful, but are we nearing the bottom? That's a question that we're asking Santosh Joseph, founder of Germinate Investor Services. And Santosh, it's an important question to ask, particularly because a lot of people started those SIPs in the post-COVID period, and a large part of their portfolios started getting dominated by small caps, as a result of which the portfolio performance of a lot of people last year has been very, very bad. But can you explain this cycle and why this last year and the start of 2026 has been particularly painful?
Hi, Alex. Markets themselves have been very weak over the last maybe 12 to 14 months. And within that, the small caps have really cooled off quite a bit compared to the market. In fact, many of them in the negative territory. Now, most of the investors who came in the last 4-5 years, and what we would like to call the post-COVID years, they were lured to the way small caps were performing. In fact, if you look at the last 6 to 7 year history, but for a brief pause in 2025, bulk of the 4-5 years has been stupendous returns, to the point that even a year like 2020, when COVID hit us, was a positive 25% plus in the small cap, which means the small cap index rewarded the investor far greater than just the market. Now, then, when you look at what has happened right now with a lot of SIPs, with a lot of flows, with a lot of invested interest, there's a general feeling that people want to be in the place where market rewards them the most, which is the small cap segment, without realizing that these are cycles. And I think you rightly pointed out that we have to understand that markets play out in cycles. Right now, what we are seeing is, after a very robust and strong cycle of performance by small cap, over the last 12 to 15 months, there is a bit of a cool off. The positive side is the people who are continuing, though they're seeing a drop in performance, they're accumulating more units. And even 2026, after we've started from Jan 1st to now, we've seen an equal amount of drawdown like the way we saw last year, which means that people are now getting to worry, saying that, did I do something wrong by investing in small caps? Okay, this is a bit of reassurance. There's nothing wrong by investing in small caps as long as you've got your asset allocation right. But this is the time to stick in and be patient and wait for the cycle to turn around, because what is known with history is that small caps reward you significantly well. This is a time for you to continue, keep your SIPs going on, maybe even take a completely fresh look, because it is quite attractive right now.
Fresh look. That's exactly the question that I'm asking, Santosh. Of course, for those people that have kept their SIPs going, kudos to them. And I hope that they're also looking at their asset allocation strategies to ensure that they're not over allocated towards one particular segment of the market. But having said that, the trigger for this conversation, at least for me, is the announcement last week that ICICI Pru Mutual Fund was restarting the lump sum inflows into its small cap fund. They took, at the time, what a lot of people counted as or looked at as a contra view when they said that we're stopping inflows. And they have assets under management at this point of just over 8,000 crore rupees, not very large. So therefore, if they're saying that the valuations have come off meaningfully, they're feeling comfort, is that a significant statement?
I think it is a big statement for a couple of reasons. Number one, they called out saying that small cap and mid caps are overvalued, and therefore they put a hold to the flows. Number two, I think we also have to understand two bits of this issue over here. Number one, that even though the index of the small cap and even some of the funds, they have underperformed, please don't forget that the small cap individual stocks have underperformed far greatly, which means the correction has been very sharp, very deep, and significant. Now you layer that with the amount of time that this has transpired with, and even the valuation correction that's happened. On one hand, the stocks themselves are available at a far deeper correction right now. time has passed by, valuations have cooled off. Therefore, I think ICICI Pru reopening right now is also a testament to the fact that you're better off today considering fresh investments for a long time than it was maybe a year and a half ago. Now, some of these things, to be very honest, is only in hindsight. We'd love to pick the bottom, we'd like to come off at the top, but it doesn't happen. Today is one such moment where we feel that it's actually not a contra view. It's maybe the fundamentally right view to say, hey, listen, small caps are not that bad. Even though there's immediate past performance is negative, there is a reason to believe that valuations, correction, consolidation has largely taken place and great time to start.
So a lot of people, and this is evidenced in the behavior that we've witnessed, Santosh, over the years also, is if there is significant underperformance of a particular scheme, there is a tendency to pause SIPs or stop SIPs and move to something else. And invariably what you have then is a large basket of schemes. So specifically with regard to the strategy in the small cap space, you're saying now is a good time to consider fresh allocations to small cap funds. How should you look at choosing the right scheme? What are the parameters that you're paying attention to right now? Because there are schemes that are very, very large, and there are schemes that are much, much smaller and have a relatively conservative view, shall we say, even if it is the small cap space.
So even before we go to answer that part, let me also tell you, for most investors, performance actually brings in attention.
Yeah.
The lack of performance, they lose attention, and that's when they tend to stop or pause. I think here we're trying to reach out to investors and saying that while performance is an important indicator, it's important that you have to ride through this cycle of performance to ensure that you come out better than just how the way the markets are performing. That's where disciplined, consistent investment comes into play. What is an important part that you have to note is that please, whether there is performance or not, during these cyclical moments, do not go overboard. I agree, there's a virtuous cycle where there's attention, there's liquidity, there's flows, there's performance that creates an unending loop saying that because of performance, you allocate more money, and because of more money, that performance of more money adds up to your portfolio overall return. So, the virtuous cycle goes on. Now you also go through the vicious cycle where there is no performance, you pull out money, liquidity dries up, and then again you pull out more money because they dropped in. So for investors watching me, please remember these virtuous and vicious cycles will keep happening now and then. Now, for those of you considering to invest today, the time is better today than it was about a year or a year and a half ago. How do you choose a particular fund? Now, typically, a good size fund selection will also help you because in a really, really large small cap fund, and mind you, in most AMCs, their largest fund today is a small cap fund, simply because investors have taken a liking and interest to chase after a fund that has got performance and has a potential to perform. But be careful, because in large funds, there will be some minor constraints to meaningfully adding stocks. So therefore, what do? Is they add a long tail of stocks, sometimes 150, 200 stocks. But if you want a kind of a concentrated portfolio, then an average 5 to 10,000 crore, or maybe even 15,000 crore fund would be ideal for you. Now, there's also enough data to suggest that sometimes just not the fund size alone is detrimental to the returns. It's also the fund manager's ability to pick stock. So very clearly put, if one were to go back and look at the consistency of the past 5 years, you'll be able to easily pick few winners.
Okay, but let's talk about style as well, Santosh, from your perspective, right? And as somebody that has a pretty long tail, very large size of AUM as well, and they've stopped lump sums, and this is Nippon, right? They allow for your SIPs to go through, but no one blames them. You're talking about 50,000 plus crore or thereabouts of assets under management at last count. At least that's what I last saw. I wonder if it's changed with the drawdown in markets or thereabouts. But having said that, what are the styles that you would pay attention to? And I ask this because I've often heard people say, don't invest in just one small cap. Look at maybe two with slightly different approaches to the way that they construct their portfolio, just so that you're not facing a significant downside and you're diversifying styles of investment as well.
Alex, I would agree with your thesis that don't put just money in one small cap. There's a reason, because whenever you add one or two or three small caps, unlike large caps and maybe large and mid cap category or flexi cap category, you do not have too many common stocks. Now, if you take most of the small cap funds that are there, and even just do a
10.
dipstick comparison of the top 10 stocks, the good thing is you get a lot of unique stocks, which means between one and the other small cap, even though there may be competition and even though you may be differing between which is good or which is bad, maybe because of performance, but you look at stocks, you have unique stocks. So therefore, having two or three small cap in your portfolio is a great bet to begin with. So I'm agreeing with that. The second part, which is interesting, is that the style of managing a small cap is also a little constrained to the portfolio manager. Let me use an example. Today, a large small cap is about 50-60,000 crores. Now, even if he has to buy a 1% exposure to a small cap stock, he'll have to buy a large quantity, and there may not be that much free float, or in some cases, even the small cap may not have that much market cap to buy that particular stock. Therefore, you'll have a long tail, 150, 200, sometimes even 230, 250 stocks. So the nature of the universe constrains the fund manager to take concentrated bets, and therefore you'll need to have a long tail. The third part is that when you look at the index, the small cap index, from a weight perspective, the last stock would be maybe 0.2, 0.3. But the portfolio manager takes that stock and gives it an active weight of 2 or 3. Remember, he's giving you significantly more exposure to that one particular stock in the portfolio that actually becomes active management. So even though the tail is long, the weightages that you give to the stock make a significant difference to the performance. And I think your example that we spoke about, Nippon, has been able to continue SIPs and flows because they managed a long list of stocks by active weight management.
Yeah, absolutely. And their largest weightage is not more than 2%, if I remember correctly. But having said that, we were talking about styles, and if you could quickly list out 2 or 3 different styles and fund managers and funds that you like and why in the space, so that people get an understanding of how they can diversify within this category as well.
So let's begin with Nippon. Nippon has largely believed that you have to play the small cap by participating in as many as good ideas as possible and maybe eliminating the obvious red flags, which is you have a index which is really quite vast, because the top 100 large cap, then the next 100, 150 mid cap, then the small cap universe is really large. So therefore, the more broader you spread out, you have an opportunity to pick up the winners. And you also have a chance here for active deselection from the index or the universe. Now, there is another player. Let's say you take an example, HDFC. They've also done well in the small cap space, but they've got a slightly lesser portfolio size. Similarly, even if you take, let's say, a Kotak small cap, what they've done is they have not gone for long list of stocks compared to how Nippon is, but they have had slightly higher weights in terms of active weights to each stock. Now, like we mentioned in the past, for an investor, playing a long tail, short tail, concentrated bet versus active bets all works very well if you're mixing up these 2-3 things in your portfolio. So here the portfolio styles are unique. There are people who play active weights and concentrated. There are people who play active weights yet have a broad and wide list of stocks into the portfolio. Now, I think whether you played active weights or whether you played concentrated stocks into the portfolio, when I mean concentrated here, it's still 80-90 stocks and not the 30-40 that we're used to in large cap or flexi cap. The benefit for the investor is that you are having a better play at the whole universe of small cap stocks. So consistency, active weights is the way to go in terms of selecting small caps.
All right, you said it. Santosh, thanks so much for taking the time. It's been an insightful, engaging conversation as always. Thanks so much.
Thanks, Alex.